Atlanta Fed President Raphael Bostic saying inflation is on the path toward the central bank's 2% goal. And Wall Street is betting the Fed will start cutting rates in March, but our next guest thinks that's just a little too soon. So joining us now, Morgan Stanley Chief Global Economist Seth Carpenter. And Seth, thank you for being here and for sticking with us through those segments. I love this quote that you have in your most recent distribution note. You say the road to a hard landing runs straight through data that looks like a soft landing. So that tells me that maybe you are just as confused as the rest of us. Help me get some clarity. Where can I look? Where can the market look for clarity about where the macro environment is heading right now?
I think the labor market data is going to be the first and most important clue there. I think judging from the comments that Raphael Bostic made that you quoted, inflation really is coming down. We were sort of really early cheerleaders that inflation was going to come down without there having to be a recession that forces things down. Some of the sort of public economists out there had been saying to get inflation down from where it was, you would need a serious recession, 7.5% unemployment. We weren't convinced. We thought it was coming down, and here we are. And so now the question becomes, what's going to go on with the growth side of the economy? We got a jobs report on Friday. It was actually a little bit stronger than we thought. But the underlying trend, if you look back over the past 6 months, the past year, the past 18 months, downward trend in labor market growth. But what's important from our perspective is you're seeing a softening in hiring. You are not seeing a pickup in firing, even as aggregate demand cools down. And that for us has been why since the beginning of 2022, we've been in this soft landing camp. We feel pretty comfortable there. For a while, markets were throwing garbage at us, telling us that we were clearly wrong. The Fed can't hike that much without causing a recession. Now here we are. And the market's actually getting a little bit ahead of us now, thinking the Fed's going to start cutting sooner. Labor market data is going to be the first place to look.
And so I'm interested to follow on that, because you said like a lot of people might have disagreed with you, right? I mean, I think if we ran the tape 12 months ago, there were a lot of smart.
If you have that tape, I'd love to see it.
Yeah, I'll get it right to you, Seth. There was a lot of smart economists though 12 months ago saying recession, we're going to tip into a downturn. You know, I'm just interested, why didn't we, Seth? Was it just the economy it just proved more resilient to that rate hiking campaign than a lot of people thought?
I think there are a few components to it. The one sort of underlying factor is we did get a lot more support, I think, especially over last year from fiscal policy than even we judged, but I think that most people were expecting. It lasted longer. People sort of look at which year is the deficit to see when that stimulus is going to happen, actually drag that over more time. But the real fundamentals for us really come back to the labor market. So we know that when the economy bounced back out of COVID, employment bounced back much more slowly. It didn't bounce back proportionally. And so that means the economy as a whole was kind of shorthanded. And so we've seen businesses up until very, very recently, essentially until now, hiring was for current needs and to backfill those positions. So that's given a little bit of a buoying effect to the economy. So that's one key part to this puzzle. I think the other part, though, take that same view. What usually causes a slowdown to turn into a recession is businesses starting to fire people. So they see slower sales, they see less demand, and they go, you know what we got to cut costs, we're going to fire people. Turns out when people lose their job, they spend less. And so the economy has less spending, so more layoffs happen, which means less spending, which means more layoffs, and it builds on itself. We're just not seeing that dynamic right now. We're seeing a reduction in hiring. We are not seeing a pickup in firing.
I'm wondering if we're starting to see hints that might be on the horizon, though. If you look, you can always tell whatever story you want, as you know, if you look for specifics in the data. But, you know, underemployment up, hours that folks were looking for over the holidays wasn't as strong as they had wanted. I'm wondering, and then we, of course, had the dreadful ISM. I'm wondering if that is just what softening looks like, or if that is an inflection point away from the picture that you're painting for us.
That's precisely why you had that quotation that you read at the beginning. Anyone who wants to see a crash, anyone who wants to see the recession on the horizon will point to exactly the same data that we're pointing to, that for us is a soft landing, and for them is the beginning of the end. But I've just heard that story so many times over the past 6 to 9 months that yes, this is a slowing down, but boy, the other shoe's going to drop soon, and it just hasn't happened.
And so I want to get your take on inflation. Do we have that CPI print this week, Thursday? What are you expecting there, Seth? And just as we look now over 2024, what does just the trajectory of inflation look like to you?
So one of the unfortunate realities of this industry and data is that there's always a bunch of noise and it bounces around. So we got a particularly soft print from inflation, especially when you translate it into the PCE inflation that the Fed looks at last month. We think we're going to get a bit of a bounce back from that. nothing like inflation taking off again. And if you sort of step back and look at 12 months in a row or whatever, all still smoothly coming down. But on a month-on-month term, we think it is going to step up again over 25 basis points on a month-on-month basis, closer to 30 basis points. And from our perspective, that might also give markets just that little bit of extra pause to go, maybe those folks over there, Ellen Zentner at Morgan Stanley, Ellen and her colleague Seth Carpenter at Morgan Stanley, maybe they're right. Maybe March is too soon.
So then when should investors be anticipating the first cut?
So our baseline very much is June, at the June FOMC meeting. But, as always, that forecast relies on the forecast for all of the incoming data to fall into place like we think. There's probably some two-sided risk to our forecast. Could be a little bit stronger, could be a little bit weaker. I would say for the March meeting, we really do need to see an underperformance of both inflation and the jobs data between now and the March meeting for it to happen. The May meeting, maybe there's a little bit more wiggle room if the Fed starts to get that much more confident. Maybe they start to worry more about the real side and they cut sooner. Yeah. But we're happy to stick with June for now.
And Seth, final question here. So you're predicting a soft landing here. When you think about maybe some downside risks to growth in 2024, Seth, what would be top of mind? Would it be like the lagged effects of that rate hiking campaign, or what are you looking for?
So I definitely think there's still so much that's uncertain about what it takes for monetary policy impulses to just show their way through the economy. And we know that over the course of the year, some business debt will get refinanced and they'll do that at higher interest rates. We know that credit quality for some, especially at the lower end of the income distribution, is starting to deteriorate as it usually does when things slow down. Calibrating that just right is hard. And so you could see a pullback either from businesses or households. I would say as well, Europe, we're feeling a little bit less confident about the strength there. We think they're going to be bouncing around zero. It could have a bit of a spillover if Europe does worse than we anticipate. But I really think overall it would be something going on with financial conditions, either the tightening that we've already seen just having more of an effect on spending than we anticipated, or maybe we're not fully out of the woods with where the banking system is.
So more focused on the inflation picture here than maybe geopolitical risks, broader global risks there?
I think that's right, because for the United States, it's so hard to figure out a clear scenario where there's going to be a meaningful way of moving the needle from the geopolitical risk. We've seen times where commodity prices go up, oil prices, for example, where they go down, where people pull back a little bit in terms of risk taking, but to have that really affect on a sustained basis the real economy usually takes something a little bit more proximate.